Hello, everyone, and welcome back to another episode of Trust Issues, a podcast from Kepler Trust Intelligence. I'm David Kimberley, and I'm part of the investment trust team here at Kepler. Before I introduce this week's guest, a reminder that past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. And with that, I hope you enjoy this week's episode. Hello and welcome back to the Kepler Trust Intelligence podcast. This week I'm joined by Ed Buttery. Ed is the CEO of Taylor Maritime Investments, which is a investment trust that invests in the shipping sector. So to get started, Ed, perhaps you could just give a brief intro on yourself, like your background, and one or two lines on what Taylor Maritime actually does.
Absolutely. Thank you for having me, David. I'm Ed Buttery, and I'm the CEO of TMI. I've been in shipping my whole life, and the reason for listing on the London trust market was really that we wanted to bring a product that gave investors access to shipping markets where you can generate a relatively consistent yield through a dividend, but also where you can create upside in capital appreciation. And I think, in its first year, Taylor Maritime Investments has managed to achieve 81% return in NAV, over 40% in the share price. We paid a 10% dividend on the $1 listing price. And I think that's demonstrated, obviously, by our timing. But what we're really trying to achieve is stability. And shipping is often known as being a little bit more volatile. And with TMI, what we do is we invest solely in the geared shipping space, which means our ships all have cranes on them. They're also shallow drafted ships, and we tend to only buy ships from Japan where we feel the quality is higher and the reliability is better than, let's say, their counterparts in China. But the point about handy-sized ships is that they can call a wide variety of ports. They carry necessity goods, as we call them. So more than 50% of what we carry is food related. That's to say anything that comes off a farm or goes to a farm, like fertilizer. The rest of what we carry is basic infrastructure materials. And the demand for these types of products is extremely stable, almost always positive in its growth, and therefore is reliable. So if you've bought cheap ships and you have a responsible capital structure, Taylor Maritime today has about net 4%, I think, debt, then you can almost always generate positive cash yield. And if you've got enough ships and you fix them out on 1-year charters and 2-year charters and 6-month charters, it means you've got this rolling conveyor belt of ships coming open, which smooths your earnings even in a volatile market. So in a market where at the end of last year we saw rates drop, let's say $7,000 or $8,000 a day, the average earnings of Taylor Maritime only dropped $1,000 a day. And that's how we protect from the downside, but still keep the upside, because of course the values are going up and down all the time. But we maintain stability in our earnings. So really, that's what Taylor Maritime does.
Okay, so you've touched on quite a lot of stuff there that I think some people listening may be familiar, but others may not. So perhaps to start with, one of the things you talked about was the fact that you invest, I think, solely in handy-sized ships, right? But so can you explain what, for someone that doesn't know, what is a handy-sized ship?
So within the dry bulk segment, the smallest of the main market bulk commodity ships is called the handy size. It's literally called a handy size because it's a useful size. They're characterized by having 4 cranes on board. They'll often have log stanchions on the deck, which sort of look like ladders that go up from the deck. And that's for obviously carrying logs on top of the deck as well. They're known for being shallow drafts, so they can call ports that don't necessarily have modernized infrastructure or haven't had dredging yet, which means, for example, they can go all the way up the San Lorenzo River Plate in Argentina, which requires a ship to have less than a 10-meter draft. And so handies are really the only ships that can go up there and load 30,000+ tons of grain. So we have a wider variety of ports we can call, but handysize are the workhorses of the sea. They're sort of the Ford Transits. They carry everything. They can access the congested ports and the shallow ports. And that's why we focus on that for the time being. We focus on handies at the moment because it is the most attractive segment to be in, and that was our opinion a few years ago, and it's turned out we were right. But that's not to say we wouldn't consider other segments one day. But what's really critical about what we do is we buy high quality ships at attractive times in the cycle. And at the moment, handysize next year as a fleet is actually contracting versus demand growth. So even if demand slows down a bit, it's still positive. Now, the handysize fleet is shrinking, so we see a very definite shortage of ships next year and the year after. And we have clarity on what's being delivered because the yards, the shipyards that build all ships, are actually full for the next 2 years with container ships and tankers. Most people would have heard about the crazy container rates that are going on around the world at the moment. And as a result, that's led to a lot of new ordering, and the yards are all filled with containers. So you couldn't build many handies even if you wanted to. So we're pretty clear about the shortage of ships in the next few years, and therefore the strength of rates that should appear.
Okay, and what are the most common products that you end up transporting? I mean, you touched. I think it's you said bulk dry commodities, but what does that mean in sort of more tangible terms? What are the products?
Corn, wheat, barley, soybean meal, sugar, cement, logs, different types of fertilizer, copper concentrates, things like that, manganese ore. But predominantly grains from farms, and that will be Australia, France, America, Brazil, Argentina, Chile, all over the world.
Okay, and you touched again on the fact that there's a shortage of ships, and that the past couple of years have been a bit crazy. Why is that the case? I mean, why you said, for example, 4 years ago that you were, or a few years ago that you were confident that handy-sized ships were going to perform well. What was the logic that went into that process? Why did you think that was going to be the case?
In the 2000s, a huge amount of private equity money came into the market, and obviously we had this huge boom. Then we had the drop in 2009, and in the 2000s, people had ordered hundreds and hundreds and hundreds of handies. In 2014, we had a false dawn. During that false dawn, a huge amount of private equity money that had made money in the 2000s piled in. Those investments went south very quickly, which actually scared off a lot of the traditional institutional investors for shipping, which meant there was a shortage of new building orders and also a shortage of money coming back into the market. And so what we thought was there's going to be limited supply of ships. Banks are gun shy as well as private equity investors. And that really helped depress values to long-term lows in 16 and 17. And that's when we started buying ships. So we managed to really buy at the very bottom. But even the IPO price was below the long-term average. And that's why we thought it was a great deal for investors. And today, people will ask, the market's done really well in the last few years. Am I too late? Have I missed the top? Well, the answer to that is probably not, because earnings are so strong at the moment. You can actually de-risk your ship very quickly if you have no debts, or actually, well, if you have debt, you can pay it off very quickly. But the point is, the yield on these ships is 25+% net to the investor on an unlevered basis. So even if you're paying slightly above the long-term average today, the cash flow generated in only 2 years on a 10-year-old ship gets you well below the long-term average of that ship, which means you're de-risked quite quickly. And that's why ships are still attractive, and that's why they're still selling. And that's another reason why you're not seeing people rushing to the yards for a ship that won't deliver for 3 years for $36, $37 million, when you can go out and pay 16, 17 million for a 10 or 11-year-old ship that still has 20 years of life left in it. and is generating 25% a year. And with a shortage of ships next year, it wouldn't be surprising if we saw values recover quite strongly. So, we're still quietly optimistic about the coming years, at least.
Okay, I mean, just from the outside and on a superficial level, I think to draw an analogy, right? If you came to me and said you should invest in this property because you can earn 25% yield on it, I would say that sounds incredibly high and perhaps not particularly sustainable. Obviously, shipping is probably rather different than the housing market, but there may be some similarities. So what would you say to someone who comes to you and says, well, that sounds great, but that also doesn't sound particularly sustainable to me?
It's unlikely to remain sustainable, but your point at which there's a yield that high leads to two conclusions. Either rates are too high or values are too low. Either way, there needs to be a squeeze. And if you look at the indicators of ship values, you've got China. China have not hit their 5.5% GDP targets. They've now promised $1 trillion in the coming years of investment in infrastructure. That infrastructure, those infrastructure imports go on handies. There's been a global grain crop that disappointed this year. As a result, we're seeing an increase in fertilizer crops, which again means governments are unlikely to take any risk on food security next year and the next crop. So we've got $1 trillion of infrastructure spending in China, trying to hit that 5.5%. We've got governments trying to create a bumper crop for next year for security. You've got a shortage of ships. And demand just has to be positive. If the fleet is shrinking and demand is not shrinking, then you've got demand outstripping supply. And even I can remember A-level economics. That's a good thing. Now, there are obviously other risk factors involved, but we are long-term fundamentals traders, and we believe in the fundamentals of this market for the foreseeable future.
Okay, and I think so far we've touched a bit on the sort of macro picture and why that's positive for you. But something else I'm interested in is just a little bit about the practical side of the business. So if you own a ship, for example, how do you connect with someone that, say, wants to ship grain from, I don't know, Argentina to somewhere in Europe or in Africa or something like that? How does that work? And does that require some sort of level of connections that perhaps, if you were an outsider, would be quite difficult to make?
Shipping, people in shipping have reputations for not falling into shipping. You're born into shipping, either as a broker or friends in the business or family in the business, and shipping tends to be a bit of a lifestyle. I mean, shipping is not just a job. People who are in it live it, breathe it, and eat it 24 hours a day, 7 days a week. Shipping is everything to me. And the point is, I grew up in the industry with people who are now at the grain trading houses. And when I was a broker in London at Clarkson's, I would call up Cargill, Louis Dreyfus, ADM, and Tate and Lyle, even people like that. And they literally say, well, I've got 30,000 tons of sugar or grains and it's got to go from A to B. And you say, well, you can have my ship for $20,000 a day. You sign a contract, got a charter party, and they pay you 15 days in advance. And you have obviously potential to take liens against the cargo, which is worth more than the contract itself. So you've got some form of security in the payment, but obviously when you're dealing with high quality counterparts like Cargill, Louis Dreyfus, and Swire, and all these big companies that Taylor Maritime deals with and focuses on, you're not particularly worried about counterpart risk. But we have brokers in London that we call up as an owner, but so much of our industry is based on personal relationships, long-standing networks, long-standing friendships, and really that's where Taylor Maritime tries to add value. It's through our supply chain connections and our reputation for always paying our bills, always being easy to work with, trying to be cooperative when problems do arise, and so on.
Okay, and just maybe on a more practical level. So if you're the ship owner, how do you make this connection? So as in, is there, let's say someone does want to ship grain, will they come to you directly and say, I want to ship grain from X to Y? Or is there a broker? Because like you mentioned, brokering is quite a big part of this industry.
And London is the centre of shipbroking, certainly as far as I'm concerned. And no, it varies. If the person happens to know you, and I make it a personal habit of knowing all of our clients personally, but if they don't know you, they generally go through a broker. Brokers fill a very important role. A lot of people outside the industry just say, well, why don't you call people directly and you don't need the broker? But brokers create the market and information flow, and they have their ears to the ground and know what's going on. And so brokers are very important to our community, especially in the handy-size segment, which is quite fragmented.
Yeah, and as another part of this, you mentioned the sort of rates that you give people to charter the ship. I mean, how long is a typical contract? If you compare it to, say, renting a house again, you might have a contract like rent a house for a year with a fixed monthly rate or a fixed daily rate or whatever it might be. How does that work in the shipping world? I mean, would just someone come to you and say, I want to charter your ship for 6 months or 12 months? Or
well, it's a bit like owning a hotel that can do day rates but also 10-year rates. So we're able to constantly readjust in a rising market, and at the top of the market, we're able to lock in those long-term rates. So we've got an average cover of 8 months at the moment. Some ships are on 2 and 3 year charters to create that sort of baseline of income, and some ships we trade on anywhere between 3 and 6 months. So we can leave them open in the event we think the market's going to get stronger. But people will come to us and sort of say, well, can I have the ship for a year and I want to notch another year? Or it changes week by week, the availability of coverage out there. But we tend to keep it pretty evenly spread out. So about a third of our fleet are on 1 year charters, a third of our fleet are on 6 month charters, and a third are on sub 6 month charters. And obviously the other thing, it's much easier to sell a ship if it's on a 6 month charter rather than a 3 year charter, and liquidity is very important to us.
Yeah, and so I mean, at what point would you consider selling a ship then? I mean, if that's obviously something that's going to be on your mind as well.
Well, my chairman always reminds me, nobody got poor taking profit. So the important thing is not to be too greedy. And you may have seen that this year we sold 5 ships, and I think all but one were over 100% IRR, and one was in the very high 80s or 90s, I can't remember. But the point is, it's not the top of the market now, in our opinion. There's still a year or two more to go as far as we can see, and it might go beyond that. But what would make us sell ships? Age, condition, getting an offer that's above the NAV, and maybe thinking we might be able to buy it back at below NAV. But essentially, we're always looking at the NAV and what we think the true value of the ship is. And if we can get a little bit more for it, then we're creating additional premium for our shareholders. And we've managed to do that successfully this year 5 times. Now, if we think it's the top of the market and we haven't sold most of the fleet already, then probably we're not very good at our jobs. But you really want to catch the sales on the rising market rather than closer to the top, because you don't want to be greedy. So I'm sorry not to give you a date and a month or a year. We're in a good market. We sold the ships we transferred the ships, because we actually didn't take anything out. We transferred the ships into the IPO at really attractive prices. So a 10-year-old at the IPO was 12.25 million, I believe, and a 10-year-old today is like 19 million. So we really tried to transfer that uplift in what we thought the market was going to do to our shareholders, and we still think there's upside value. Just to give you an example, a 10-year-old ship today might be $19 million. A 10-year-old ship in 2006 was $37 million. So people have seen us go from 8-9 million for a 10-year-old up to 19, but historically speaking, we're only halfway.
And how easy is it for you to sell a ship? You mentioned you sold 5, which kind of implies that it's it's a doable task.
Liquid
So
market. If you're known for being easy to deal with, not too greedy, accommodating when practical problems arise, and if you have Japanese ships, you tend to have a bit more liquidity than some of your counterparts. So one of the reasons we focus on Japanese ships is that they're just much easier to sell in a difficult market. In a difficult market, ships from other nations just don't get inspected at all. There's no interest, and we really wanted to avoid that. And it's also important, obviously, to have the same ships for our customers, so they know we've got a homogenous fleet of high quality ships.
Okay, well, to move on a little bit, I think that most people are aware of the fact that the shipping industry and supply chains and so on have gone crazy basically over the past 3 years because of COVID, because of the war in Ukraine. I wonder if first you can talk about being sort of more on the ground, as it were. What has actually gone on to make prices go up so much for, say, chartering or whatever it might be? But also, do you see those problems coming to an end in the near term? And if so, what impact will that then have on you or on Taylor Maritime?
Are we talking about bulk or also containers? I may have missed.
Yeah, I suppose just for for bulk or the shipping industry as a whole.
I mean,
really,
what's made ships go up is we came out of COVID with this pent up demand, and the world's getting back into gear. Restaurants are opening, hotels are opening, which is why lockdowns are not very good. They're not very pleasant for demand. But as we came out of COVID lockdowns, the world came back to life, and demand suddenly shot up. But of course, for 3 years, nobody built any new ships, and nobody ordered new ships. So we had suddenly a rapidly growing demand and zero supply. What can Taylor Maritime do? We could sell ships. We can lock in longer term charters to create downside protection. There's a number of things, but those are trade secrets, and you'll have to see how we do it in the coming years.
Okay, and I mean, one other question I had was just related to the types of cargo you have. So if you imagine I charter a ship, so let's say, well, in some sense, the time is irrelevant. It's more like if I'm chartering, one commodity that is going to make me a lot more money than another, does that then affect how much you charge them to charter the ship, or does it have no bearing?
Well, so Maritime takes part in a type of lease called a time charter. And a time charter, we charge $1 per day. We don't take risk on the weather, the time. We don't take risk on the cost of fuel. So our customer takes all those risks off our hands. And so, no, the market in the time charter is more or less the same, depending on where you are, but it's more or less the same regardless of the cargo on board. It's the traders who are our customers who are taking advantage of the difference in value between your cheaper commodities versus your more expensive ones.
Okay, great. And I mean, perhaps to finish off, are there any sort of nuances or areas of the industry that if you're a prospective investor, you think this person should be aware of? So if I'm coming to Taylor Maritime, beyond the obvious qualities you've described so far, are there any sort of key facets that people should be aware of, particularly if they're more sort of unexpected, or you wouldn't necessarily know about them if you were an outsider?
Well, it depends what kind of investor. If you're looking for yield, just be really wary of how much leverage companies have on their balance sheets. Historically speaking, shipping companies have a lot of leverage, and it just reduces your margin for error when the market turns. Second of all, I'd always look at the quality of the ships they buy. Are they built at the best yard? So for handy-size, we'd say Japan. For containers, you might say Japan and China. For gas ships, you might say Korea, for example. So quality of ships, capital structure, reputation of the management is critical. Do they have a good track record? Are there any hidden management fees, or are they transparent about it? But really, it's track record is everything. Do your research on the people who are managing your ships, and do your research on the managers who are running your investment. it can be cyclical, but it doesn't have to be. And hopefully TMI is proving that we can offer downside protection, but with upside exposure.
Fantastic. Well, I think that's a good point for us to stop. So, Ed, thanks very much for joining me. And thanks everyone for listening. If you are interested in learning more about Taylor Maritime, then head over to the Trust Intelligence website where we have a full research note on them. And yeah, that's it. So thanks, Ed, again for joining me. And hopefully we'll speak again soon.
Thanks very much, David.
You've been listening to Trust Issues by Kepler Trust Intelligence. You can subscribe to the podcast on Apple Podcasts or Spotify. Remember to visit our website at trustintelligence.co.uk to keep up with all the latest research on investment trusts.